I want to welcome everyone to today's lesson. Okay. Today we'll talk about Chapter 13, Analysis of Financial Statements. Okay. So the first one says, using the following data from the comparative balance sheet of Goody Company, illustrate horizontal analysis. Now remember, horizontal, we're going straight across. So in this case, we're looking from 2014 to 15. Okay, so each account, we want to see what was the amount of either increase or decrease. So see for the first account, we see here the amount, it went up. From 2014 to 15, subtract the 520,000, 400,000. That'll be went up $120,000. Okay, keep doing that for the next one. For the inventory, inventory says went up now $240,000. And the last one, total assets went up $500,000. Okay, now the next part says you want to get the percentage increase for each one. So remember, to get the percentage increase, take the amount of the difference. So we'll start with accounts receivable. Take the $120,000. And then what you want to do is divide by the original amount, which was the amount we started with, which is 400,000. Divide by 400,000. That'll be 0.30, or in this case, 30%. So we go over here the percentage. So now we know it went up by 30%. Okay, now you want to do the same thing now for inventory. We know inventory went up $240,000. And divide by the 2014 amount, which is $600,000. Okay, so that will give us this one at 40%. So it went up 40%. Okay. Keep coming down. Okay, and the last one, for our total assets, take the 500,000 and the difference, and divide by the 2014, which is 2,500,000. Okay, so that'll be the last one at 20%. Okay, keep going down now. The next one now. So use the following data from the comparative balance sheet of Goody Company. Illustrate vertical analysis. Now remember, vertical is the opposite. Remember, horizontal, like we said earlier, we went up and down. I'm sorry, horizontal went straight across. Vertical, we're going up and down. So for each one, you want to see what percentage is of the total. So we're here at 2015, 2014. So we start the first one, accounts receivable. So we take the 520,000 and divide by the total assets, which is 3 million. So we see here the percentage is, we want to go one decimal spot, 17.3%. Okay, so I'm going right over here, put 17.3. Okay, continue on now. For inventory, you want to do the same thing. Take the 840,000 and divide by the 3 million. Okay, that'll be 28% on the dot. Okay, so we see it's 28%. Okay, now the other one for total assets, well, we could divide it, but that's just going to be 100% because 3 million divided by 3 million is 100%. Okay, on the next one now. Start with accounts receivable. Do the same thing for 2014. Take the 400,000, divide by the 2014 total, which is 2,500,000. That'll be 16%. And inventory, same thing. Take the 600,000, divide by the total assets, which is 2,500,000. That'll be 24%. And the last one, again, if you want, you can write it out, but 2,500,000 divided by itself is, of course, 100%. Okay. Go down to the next one now. Number 3 says compute. Start the first part. The first thing it asks for is compute for each year the inventory turnover. Now remember, to get inventory turnover, we have to follow the formula. It'll be cost of goods sold divided by average inventory. Okay. So now, remember, to get average inventory, you got to take your beginning inventory plus ending divided by 2. But before we go any further, you calculate our cost of goods sold for each one. Okay. Now, to get cost of goods sold, you got to follow the formula. So we start the first part. Begin inventory, which is, start 2015. See, it's $940,000. Okay. Then we go to 2014. Okay. Their beginning inventory was $860,000. next line here, you want to add the purchases. Okay, purchase of 2015 was $4,340,000. And for 2014 purchases was $4,661,000. Okay, now remember, this would give you my cost of goods available for sale. Just want to add them together. So for 2015 it'd be $5,280,000. Okay. In 2014 it'll be $5,521,000. Okay, and now the next part, you got to subtract the ending inventory. So 2015 is $1,020,000. And for 2014, it is $940,000. And remember, subtracted. So subtracted cost of goods available for sale minus inventory for 2015, cost of goods sold will be $4,260,000. In 2014, it'll be $4,581,000. Okay, so again, so 2015. Let's go up here to get our cost. Started cost of goods sold. So now we know cost of goods down 2015. It's going to be $4,260,000. Now remember, we have to divide by the average inventory, which is beginning plus ending divided by 2. So take the $940,000 beginning, add the $1,020,000, and divide by 2. So remember, when we do this, this will give us, over here, and now remember, add this and divide this together. Okay, so when we do all that, that'll give us 4.3. So inventory turns over 4.3 times. So 2015, we know it's going to be 4.3. Okay, now you want to do the same thing for 2014. Start with our cost of goods sold, just calculate it. We know that's $4,581,000. And again here, divide by the average inventory. Beginning, which was $860,000. Plus the ending inventory, which is $940,000. Divide by 2. Okay. Now remember, when we do that, we add it together, that'll be 5.1 times. So now 2014, inventory turns over 5.1 times. Okay. Now the next part says you want to calculate your days in inventory. So again here, we use 365 days, no leap year. Okay, all it is just 365 divided by inventory turnover. So 2015. Take that 365, divide by, for the first one, 4.3. Okay, so when you do that, that'll give me 84.9 days. Over here, so about 84.9. In 2014, you want to do the same thing. Okay, take 365, but now remember, this is 5.1, so divide by 5.1. Okay, that'll give me 71.6 days. So inventory days average 71.6. Okay. All right, let's go to the next one now. Number 4. Number 4 here says, prepare an income statement beginning with income from discontinued operations. We see here, travel company has income from operations, extraordinary loss, a gain of $30,000, correction, and a 30% tax rate, beginning with continued operations. So again, we saw the first part. It says, start with continued operations here. So he says here, for continued operations, $290,000. So again, we got the first part down. When the first line income from continued operations is $290,000. Then we start at discontinued operations. Okay. We see here, we had a gain on discontinued operations. Well, let's see how much it was for. Okay, it says here, gain was $30,000. Okay, so start with the $30,000. Okay. Except, don't forget here, it says here you have a 30% tax rate. So we're going to do a subtract 30,000 multiplied by 30%. Okay, so when you do that, this will be 21,000. So our gains and operations will be $21,000. All right, now when we do that, what you want to do now is add them together. Take the 209,000 plus 21,000. That'll be $311,000. Okay, and the last part would be my extraordinary loss. Okay, now remember, to get your extraordinary loss again here, it says your extraordinary loss of 80,000. So again, start with the 80,000. Okay, as we did earlier. Now subtract, 80,000 multiplied by the 30%. Okay, so when we do that, that'll be 56,000. Now remember, this is a loss, 56,000. So we're not going to be adding to the 311. You subtract from 311. Okay, that'll give me 311,000 minus 56,000. That'll be $255,000. Okay, now last part says data from Target, Walmart, year. Okay, we have Target's information. Okay, we have net sales, cost of goods sold, we have the income statement, and the balance sheet. Okay, now it says here, complete the data. So we want just Target's, start the first part, we want its current ratio. Now remember, current ratio means take your current assets, which in this case, start number 1. Okay, my current assets. So I go up to Target and get their current assets, $18,906. So I'm going to take the $18,906 divide by my current liabilities. So I go over here and find my current liabilities. End of the year, $11,782. So okay, take the $18,906 divide by the $11,782. Okay, that'll give me a current ratio of 1.6. Now remember, current ratio means 1.6 to 1. That means for every $1 of current liability, you have $1.60 of current assets. Okay. Now, next part, number 2, you want to get your accounts receivable turnover. Now, to get your accounts receivable turnover, what you want to do is start with your net sales, which we saw just got up there. That was $61,471. Okay. And then we see what are we going to divide by. Okay. What you want to divide by is your average net receivable, which is given to us at $7,124. So divide by the $7,124. So my AR accounts receivable turnover would be 8.6. Okay, that's the next part now. My average collection period. Well, average period, again, through 365 days, and divide by what we just calculated, my AR turnover, divide by the 8.6. Okay, so that'll be 42.4. Okay. Next part, let's go to my inventory turnover. Now, we did a little bit earlier, the inventory turnover. So we start with my cost of goods sold. So I go up here, remember, it's an expense. I see it's $41,895. Okay, so take the $41,895. And what you want to do is divide by your average inventory. In this case, it's good. It's given to us, $6,517. So take the $6,517. You divide that, that'll be 6.4. The return turnover 6.4 times. Okay, next part, my days in inventory. Okay, well, remember, you have 365 days and divide by the inventory turnover, which is 6.4. Okay, remember, when we do that, that'll be 57 days. Right on the dot, 57. Okay, next one now. Number 6. Our profit margin. Remember, profit margins. Okay, let's take our net income, which will come up here, $2,849. Okay, and divide by your net sales, which we used a little bit earlier, $61,471. Okay, that'll give me a profit margin of 4.6%. All right, the last one, my asset turnover. Well, again, your asset turnover starts with my net sales, which we know is, we just got it, $61,471. Okay, and then what you want to do is divide by your average assets. So we saw there, beginning of your balance, assets was 37,349, and your assets 44,560. So again, when we take those, take the 44,560 plus the 37,000, 349 divided by 2. Okay, remember, when we do all that, that'll give me an asset turnover of 1.5. Okay, all right, class. Hope everyone's doing well. Remember, if you have any questions or comments, always feel free to contact me, okay? All right, bye. Take care.